Corporate Finance, Excel, practice problem. In this presentation, we're going to work a practice problem in Excel related to the price-earnings ratio. We're going to be comparing two companies that have the same earnings but have different capital structures in that one company has more debt, the other company has more investments from owners in the equity section. Get ready. It's time to take your chance with Corporate Finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side. We're going to have two different scenarios, scenario A and scenario B, and we're going to have the earnings before interest and taxes is going to be the same for A and B, the total assets the same for A and B, but we're going to have a difference in the structure in that A has more debt and B has more in the equity. So A has 850 in debt versus B of the 290, and then if we look at the equity, we see that A has the only 575 compared to the 1,135. So these companies are similar in performance, but they have different structures with regards to liabilities and equity. To flush that out or to see that a little bit more clearly, let's do a little accounting equation. Let's just plug this into our accounting equation down below. Assets equal liabilities plus equity. We're going to look at A and B. And we're going to say, okay, for A, we're going to pick up the liabilities or the debt, and that's going to be equal to this 850,000. And then if we look at the equity for A, the equity for A is going to be the 575, and that'll give us the total assets, right? Assets are going to be equal to the sum of the liabilities and the equity. Then if we think about B, B then has the liabilities of the 290,000, and they have equity of the 1,135 to give us the total assets, once again, the sum of liabilities and equity of the 1,425. So once again, the assets are the same, different structure. So the assets are what the company has, but they've been broken out in two different ways with the capital structure of that assets, liabilities versus equity being different for company A and B here. That then gives us the debt and the equity. We also have to calculate the earnings per share. We have the tax rate of the 25% for each. Then we're going to say the price to earnings ratio is, we're going to start off with two scenarios with it. We'll start off with the same price to earnings ratio, the PE ratio, to calculate the market price. And then we'll think about a scenario where they're going to be different. And you would think there might be a case where A would be lower, the price to earnings ratio, meaning the market price will be lesser of a multiple of the earnings per share due to the fact that they have more liabilities in compared to E, due to the financing structure of A compared to B. So we're going to start off with our partial income statement. They're giving us the earnings before interest and taxes. So we're going to start there. That's basically the bottom line of the income statement before we calculate the interest and taxes. We're then going to be picking up the 170,000 for both A and B. They're the same at that point on the income statement. Then we have the interest. So the interest, which is going to be equal to, and we're going to be picking up the debt times the rate here. So the rate is the same, but the debt differs. Now the interest then is going to differ due to the difference in the financing. So we're going to be picking up the 850,000 times the 14% for A. And then for B, we're going to be picking up the 290,000 lesser of the debt times the 14%. So even though they had the lesser of the net income before interest and taxes, or operating income, or earnings before interest and taxes, all the same, then we have the interest is going to be substantially different due to A financing more of the company with debt, which they have to pay interest on, B financing more with the stock, which has they both have their pros and cons, right? Because if you take out debt, you got to pay the rent or the interest on it. You take on a risk with relation to that. If you finance more with the equity, you're giving ownership or voting power to more individuals as well. So there's pros and cons to the two here. So we're going to then put an underline. We're going to go to the Home tab, Font Group, and underline here. That's going to give us the earnings before taxes. So we'll have then the earnings before taxes calculated as the earnings before interest and taxes minus the interest. And that's going to be equal to the 170 minus the 40,006 here. Then we're going to have the taxes. Taxes are now going to be calculated using the 25% same rate. But now we have a difference in the bottom line number. So notice that the interest for A becomes a tax deduction. So they're actually going to pay less taxes because now they're taxable. The amount that's going to be taxed will be less due to the fact that he gets to deduct the interest, whereas B doesn't have the interest because they financed not with taking out debt, but with more of equity, issuing stocks for it. So we're going to say this will be the 51,000 times the interest of the 25%. And this is going to be then equal to the 129,000 times the tax rate of the 25%. So once again, B's paying more on the taxes due to the fact of how they're financing the business. So then we're going to say that we have the earnings after taxes will then be equal to the earnings before taxes minus the taxes. Same here. This is going to be equal to the earnings before the taxes minus the taxes. We'll put an underline on the cells above, go into the Home tab, Font Group, and underline. Then we want to pick up these shares because we want to calculate the earnings per share. So I'm going to now say, okay, there's our earnings. Now let's pick up the number of shares that are outstanding so we can break those earnings out into their unit categories per share. So we're going to say this is going to be equal to the shares, which are 115 for A. Remember that means that there's that many shares outstanding. Does not mean that we have 115 owners, because one owner can have multiple shares just like one person can have multiple dollars that represent purchasing power. But the shares are going to be that standard breakout of ownership. So the shares are the standard breakout, 115,000 shares outstanding for A. B, because they financed with equity, has more shares outstanding, right? They got the 227 due to the fact that they financed more of their business with the equity as opposed to the debt. So that means that if we take a look at our earnings per share, which is earnings EPS, is going to be equal to the earnings after taxes or net income divided by the number of shares. So let's add some decimals here. We're going to go to the Home tab, numbers, add a few decimals. You could keep on going. We're going to stop at 2 because we're talking basically dollars and cents here. So we're talking 0.3333 cents. And then we're going to go to B, which will be equal to the 97,050 divided by the 227. Let's go back on over to Home tab, numbers, and we'll add a few decimals there. We could keep on going. We're going to stop at 2. We're at 0.43. We're going to then put an underline up top. We're going to go to the Home tab, Font Group, underline. So notice we started at the same net income number, but then due to the difference in the financing, we had differences in interest rates. A's being higher because they financed more with debt as opposed to the equity. That resulted in differences in taxes. A's taxes being lower due to being able to deduct the interest on the way they financed. And then the number of shares now being different due to B financing the company more with equity, therefore issuing more shares outstanding, resulting in our earnings per share for A and B being different. A at the 0.33 or 33 cents about, and the 43 cents about for B. So now let's calculate the stock price. So if we think of the stock price as basically being, if we look at it, the price earning ratio being the same at say 21, we're going to say that the earnings per share then are going to be equal to, I'm just going to pick up these numbers again, this number and this number. I'm going to format them again, selecting these two tabs, Home tab, and we're going to go to the numbers and add some decimals. And then we're going to be picking up the price earnings ratio, which is going to be that 21. So that's going to be the price to the earnings, meaning price over the earnings per share. So if we have the earnings per share, then we're going to use that as the multiplier to get up to the stock price. Whereas if we were given the stock price, we could figure out then the PE ratio. So now that's going to give us the stock price. And remember, the stock price is going to be based on something outside of the company. So it's not like the earnings per share are deriving the stock price. We're looking at the relationship between the stock price and the earnings per share. Everything we've done thus far is internal to the company's bookkeeping. The stock price is outside of the company's bookkeeping. So now we're going to be saying that the earnings per share times the 21 gives us 7. Let's go ahead and add some decimals. Home tab font group, add a few decimals. We could keep going. We're going to stop at 2, as is our normal tradition here. That's going to be 6.98. Then we're going to have 21 also for B here. 21 for the PE ratio. That's going to be equal to the 0.43 times the 21. We're now at 9. Let's add some decimals. Home tab font group, adding a few decimals. We could keep on going. We're going to stop at 2. Then I'll put an underline under the 21. Home tab font group, and we'll have the underline there. So even though we have the same multiplier here of the 21, and we have the same net income, we have the differences in the earnings per share as well as the stock price due to the difference in the financing that we took a look at. Now you might have further differences, of course, because again the stock price is something that we're not determining by these things. The market's going to determine them. So you're kind of guessing about what the market will do. Now, and also note that you might have the stock price here on the market and then be trying to figure out the PE ratio for your analysis. So if you had the stock price, you take the stock price divided by the earnings per share, and that would give you the PE ratio. Okay, so then in scenario B, we have a situation where we can think about, well, it could be quite possible that the PE ratio would differ due to the difference in financing. So we might have a difference, even though the net income is the same, the stock might value these two firms differently. You would think that they would value, they could quite possibly value the firm that's going to be financed through debt lower because the debt is going to have higher leverage, and leverage comes along with more risk. So if you have all else equal, if the revenue is coming in equal up top here, but one company is being financed more with the debt as opposed to the equity, then that could be cause for concern in terms of possible risk due to the leverage in the future. In the case of a downturn, the more leveraged firm usually suffering more in the case of a downturn kind of situation. So then we would say, well, what if we had the PE ratio was 17 and 21? So we'll do the same thing here. We're going to say, all right, well, if the earnings per share started off at the 33 and the 43 cents, and we highlight those two or select them, home tab, per numbers group, add a couple decimals, then we're going to say the PE ratio is now going to be 17 and 21 to give us the stock price, which is going to be equal to the 0.33 times the 17 and equal to the 0.34 times the 21. Then we're going to add some decimals there, selecting them, home tab, numbers, add a few decimals. We could keep on going. Let's stop at 2. Let's then add an underline, going to the 2 items up top, going to the home tab, font group, and underline. So then we could have a stock price that could be more significantly different, and most likely would. Again, the stock market, has a lot of different factors that would be involved in it, but you would think based on this information that the stock price might, the market might value in and determine that the PE ratio related to A would be lower than that for B due to the fact that A has financed more leverage in their financing options.